Alright, welcome back to MMG. So this video may be really important. Okay? And stick around for this video. First of all, this is not financial advice. Consult your financial advisor. I'm not your licensed financial advisor. Consult them before doing anything. Stocks, bonds, metals, everything extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. Essentially, when you invest in stocks, that's extra money that you have that you are willing to lose. All right. Half stops in place, emotions out. Right. All right. So, and I'm not always right, but I've been doing really well. Okay. I'm going to talk about the repo market again. Economic data also came out today. It was very weak. I'll talk about that for a second. And then I'm going to talk about a few things here and there. And then I'm going to do some TA on the stock market and metals. All right. So the system might be blowing up right now as we're hitting all-time highs. Which actually, that's how it always happens. Everyone's very complacent, and everyone thinks everything's fine. Euphoria, the stock market's hitting all-time highs. Wall Street probably thinks the Fed has everything under control. They're doing preemptive cuts. The repo purchases, not QE, is QE, and it's helping the markets. And I'm going to dive into why it is QE. Because this isn't coming from me. This is actually coming from another bank, a major bank, okay, the CEO. But first of all, with the QE thing, they just recently said, if you remember in the beginning, the QE thing was only going to last a couple days, then 14 days, 2 weeks. Now, this is an ongoing thing throughout 2020. That's what they're saying now. And it's not even 2020 yet. So it's debt monetization for the banks. And I'm going to go deeper into this, but the fact that this is going to be an ongoing thing, permanent, probably permanent from now on, because they can't reverse it once they start doing this as well. Same with interest rates. They can't normalize interest rates, so they're permanently low now. Because what happens if they try to normalize the system? It blows up. It's that simple, guys. That's what happens when you create asset bubbles and you create endless credit expansion. Like I said, once the money and the debt is out there, because money is debt, straight from JP Morgan's mouth, the guy who created one of the biggest banks in the world, no, the biggest, credit, money is credit, and credit is debt. No, everything is credit, and gold is money. Something like that. It was something like that. So, let me read this. The desk will also offer 3 additional term repo operations during this calendar period with longer maturities that extend past the end of 2019. These additional operations are intended to help offset the reserve effects of sharp increases in non-reserve liabilities later this year and ensure that the supply of reserve remains ample during the period through year-end. They are also intended to mitigate the risk of money market pressures that could adversely affect policy implementation. The desk will adjust the timing and amounts of repo operations as necessary to maintain an ample supply of reserve balances over time. This is from the FOMC. And they're saying that they're going to do this every 28 days to 42 days repos, and then do them as necessary. So every day as well. And New York Fed is maintaining its 120 billion in overnight repos indefinitely. Here's the repo operations. They're increasing towards the end of the year this year. And essentially, the repo market is no longer a private market where the banks are doing it. They're providing liquidity for one another. The central bank is becoming the centralized liquidity provider for all the banks overnight. And that creates major risk. All right, and I'm gonna read you guys what the banker said. I think it's Bank of America. But let's finish this article. In our view, the most worrying part of the Fed's current asset purchase program is the realization that ongoing bank footprint in repo markets is required to maintain control of policy rates in the new floor system. What does that mean? That means to keep interest rates, the federal funds rate, low. And, the treasury rates on the short term from, the 6 month to the year, 2 year, 3, the 10 year, to keep interest rates artificially low, the central bank has to go in and provide liquidity for the overnight. Because if the overnight dries up, what happens? Interest rates on bonds start spiking. What happens when the rates on these bonds and all the debts start spiking? Then the debts come due. And then what happens? It causes a credit crunch, meaning people can't pay. Institutions, corporations, banks, you name it, everyone can't pay the interest on all the outstanding debt that is already out there. So that is why they have to do this. All right. Not just that, there's no cash in the system. It's kind of like a run on the cash funds. Some have argued, including former New York Fed President William Dudley, that the last financial crisis was in part fueled by the Fed's reluctance to tighten financial conditions as housing markets showed early signs of froth. So, back in 2008, they sort of did the same thing. Not so much with they did do the repos as well. When the time comes for the Fed to unwind its temporary repos, we hope it will be more successful than when it tried to renormalize monetary policy, which lasted for a few months, and then the Fed admitted defeat in a dramatic U-turn and is now cutting rates instead. So, in the beginning, what caused this repo market to dry up, the interbank lending, the overnight lending of banks to each other, was the raising of interest rates earlier this year and prior year, 2018 and 2017. And they kept raising rates, try to get to 3%, and that was enough to cause this. All right. And then they reversed policy, and stock market's hitting all-time highs. Supposedly the economy's booming, and they're lowering rates and they're injecting liquidity into the overnight, right? So something's up. Something's happening behind the scenes. Another thing that may have caused, and this isn't like proof or anything, this is just rumors. JP Morgan may have caused the liquidity crisis for the overnight lending, right? Why is that? Because they took hundreds of billions out of the repo market. Like, they took their cash and they just parked it in long-term bonds in the 30-year. Because the 30-year interest rate actually stays higher than the rest when I can't swear apparently now because they changed the rules. So when the SHTF happens, and you guys know what that means. I said it on my last video, and apparently that was, Anyways, so JP might have actually caused it. Now it's funny because I'm going to read a little more into this, how they might benefit from this repo madness. So pay attention, all right? So one bank finally admits the Fed's not QE is indeed QE. So one bank finally had the guts to say what was so obvious to anyone who isn't challenged by simple logic. The Fed's not QE is really QE. Bank of America's Ralph Axel writes, so Bank of America, I'm not saying this, not some gold bug saying this, not some bears saying this or some random analysts. It's coming from Bank of America itself. And BOFA. These are one of the biggest banks in the world. So Bank of America, Ralph Axel writes that in the aftermath of the Fed's new program of T-bills purchases to increase the amount of reserves in the banking system, the Fed made an effort to repeatedly inform markets that this is not the new round of quantitative easing. And yet, as the BOFA strategist notes, important ways it is similar. Should not be confused with the large-scale asset purchase program that we deployed after the financial crisis. In contrast, purchasing T-bills should not materially affect demand and supply for longer-term securities or financial conditions more broadly. Chair Powell gives us a definition of QE as having two basis elements: supporting longer-term security prices, and two, easing financial conditions. You guys have to remember, in 2008, 2009, it was unprecedented. No central bank, well, maybe Japan, but the U.S. is the largest economy in the world with the world reserve currency status. The world's never seen an empire this big with the world reserve currency status all of a sudden print trillions of dollars and inject it into the system to save it. And that was called QE. And they put like $4 trillion on their balance sheet. $4 trillion, which is huge. And in previous videos, I showed you guys how much money that is because most people can't really fathom it. All right. You could stack it to the moon or something in like $100 bills or something like that. Anyways, let's continue. Bank of America now writes, the Fed's T-bill purchase program delivers on both fronts and is therefore similar to QE with one exception: the element of forward guidance. Forward guidance is just, getting in front of the mic during these FOMCs and then just telling the market what's sort of coming without surprising them, but sort of keeping them on the edge so they don't, so the market doesn't price everything in too quickly. That's what forward guidance is, which is, that's one of their tools, by the way. It's kind of directing the market where to go. And where is that? Always back up. All right, guys. The upshot to this attempt to mislead the market, what it is doing, according to Bank of America, is that the Fed is continuing to ease, even though rate cuts are now on hold, which is supportive of growth, higher interest rates, and higher equities. And two, the Fed is loosening financial conditions by increasing the availability of lowering the cost of leverage, which broadly support asset prices potentially at the cost of increasing systemic financial risk. All right. So that's interest rates. They're lowering interest rates back down, and they said they're not going to keep easing, but they are because they have to. But they pretend like they don't have to, right? So they're saving face for the markets, like everything's okay, guys. We're just doing this as a security measure because of trade and global slowdown, whatever. All right. And the only reason the markets keep going higher and higher, all-time highs, is because capital flight from around the world into U.S. markets. I feel like all the U.S. investors are all in, or they're smart money and they're on the sidelines and selling into cash. And, smart money is going into metals. That's why it's rebounding again. And possibly, TIPS, inflation-adjusted bonds, and maybe 30-year bonds like JP. Putting the Fed's not QE in context, so far the Fed has purchased $66 billion of T-bills and may purchase 66. Okay, who wrote this? So this was by Tyler Durden. You guys know who that is. All right, Zero Hedge, right? Um, let me continue. I have to give him credit. All right. So 66 billion of T-bills and may purchase 60 billion per month through June 2020. So until next June, which could result in an increase in the Fed's treasury holdings by about 500 billion. That's half a trillion. And that's only with 66 billion. Now, they're probably going to increase that, so it could be over $1 trillion by next summer, easily. And at that point, even the market can't ignore that, even the moon boys, right? As Axel writes, there are two basic mechanisms how T-bill purchases support long-term security prices: the increase in cash assets and deposit liabilities on bank balance sheets, and the reduction of funding risk for leveraged buyers of treasuries, mortgage-backed securities, and other financial securities. So at the same time, the Fed's lowering interest rates and they're injecting money into the banks, which helps the banks do irresponsible things, right? It's really, sweeping everything under the rug and then allowing them to leverage up even more. For those who have forgotten how the asset reflation pathway works, recall that the Fed either buys T-bills from investors such as money market funds or from primary dealers who do not hold T-bills, but can buy them at auction to sell to the Fed. Buying from investors converts their T-bill holdings into new Fed cash, which in turn winds up on deposit in the banking system. If instead a primary dealer buys a T-bill at auction and sells it to the Fed, the transaction results in new Fed cash placed in treasuries cash account, while the dealer balance sheet is unchanged and the banking system balance is also unchanged. But once the Treasury spends the new Fed cash on Social Security payments or medical insurance bill, etc., everything, the cash enters the banking system and increases the aggregated balance sheet of banks. So you guys can read that again. It's in the newsroom. By the way, if you're not in the newsroom, that's where I keep you guys up to date every day. And there's a lot of great stuff I put in there. If you're not in the free, it's in the description section below this video. The link says newsroom, MMGinvest newsroom. And then there's like a bunch of free chat groups. And then there's the private groups. Oh, by the way, I always forget to do this. You guys need to do me a favor. Do me a favor, guys. I have two YouTube channels. One is at 6,950. It used to be at 6,970, but as of late, my channel's stopped growing completely, and I'm losing people now. So that's my big YouTube channel. My smaller one is at 977. So, the only difference is one, it has a space between MMG and Invest, and the other one does not. So if you're only on the larger YouTube channel, please go to my smaller one so I can get that over 1,000 finally. And if you're on the smaller one, please go to my larger one and subscribe there as well so I could get that over 7,000. So I could really keep track of how they are really trying to kill my channels. And so we can mess with the algos. And it helps me out a lot. I need to get this one above 1,000. All right, the smaller channel. Also, go to my website, 15% off. I understand everyone has to buy gifts for, the holidays. So 15% off. You just click on MMGinvest here. You just type MMGinvest in the search. It'll pop up. It's the first one. And pay good money for that. And then watch this video so you understand what I'm providing you. And then join the private group. You'll get an email invite. It's $10 a month. Guys, I'm undercutting everybody by a lot. These services are usually like $2,000. Or they're like $300, $500, or $200 a month. It's a one-time payment of like $275 and then $10 a month. and then the product pays for itself. All right? And, I don't know when the giant correction is going to happen for metals. I'm talking about when the margin, everyone hits the sell everything margin. That might happen after gold's run up to 2,500 or something. Who knows? I'm not a prophet. So you want to have your toes wet if you really want to take advantage of the mining stocks exploding in value. Like, I'm serious. An ounce of silver, $150, if it just goes to that, you're going to do great. Really great with the mining stocks. If gold goes to 3,000, you can do really great, like life-changing. But I honestly think it's going to go way past that. But, we'll see. So you don't want to miss the opportunity. And that is money you're willing to risk and lose. It's not your retirement. It's not your life savings, all right? Even though personally, that's what I'm doing. All right, so you want to have physical as well. You do a little bit of both. You want to diversify. Don't have all your eggs in one basket. All right, I'm going to make another video, trading tutorial and strategy portfolio video later tonight, hopefully, and so you guys can watch it over the weekend. All right, let's get back to this. Where was I? All right. So either way, bank balance sheets expand, and banks will need to, 1, hold more HQLA, high-quality liquid assets, against those deposits, and 2, put some of their new cash to work in longer-term securities such as mortgage-backed securities or even stocks, which is literally leveraging up towards the tail end of the largest equity bubble in human history. So these banks are going to be in trouble. Although banks can be flexible in how they deploy the new cash, it is likely that a portion of it will go into bonds similar to what banks already hold. Currently $1.8 trillion in mortgage-backed securities and $770 billion in treasuries, according to Fed data. And once bonds are bid, other investors have no choice but to reach for even riskier securities, such as stocks. Hopefully some of these banks will be smart and they'll go into the metal stocks. I would love to see that, because that'd be hilarious. Because the Fed prints, liquefies these banks, and the banks buy metal stocks. And then that's the largest wealth transfer in human history. Besides, all the stocks crashing, and then all that money flows eventually into metal stocks, because it's the only assets that aren't in bubble territory. It's the only undervalued asset in the world. What else is undervalued? Name me something. Give me something. I can't think of anything. All right. Meanwhile, the Fed does not directly lend to leverage investors. Some of the increased cash on hand at banks will likely go into repo markets to fund overnight loans to potential buyers of long-term securities and treasuries or mortgages. This, as Bofa explains, is how the increase in reserves is designed to calm repo markets. So that's what they're hoping will happen. The amount of bank lending in repo has increased by about 50% since the end of 2017, which is a lot. Focusing just on the increasingly more important repo channel, which is one ingredient within overall financial conditions, is becoming more important as the reliance on overnight funding and leverage continues to rise. So you guys have to understand, as interest rates are kept artificially low longer periods of times, to keep the party going, that means people and institutions have to keep borrowing. That's the only way the party and the music keeps going. So that means that overnight lending has to increase as well. That's another reason why why central banks have to do this repo operations. And believe me, they're doing it in China. They're gonna start doing it in Europe if they're not already doing it. And that's how you keep the music playing, but it's absolutely unsustainable. And that's despite all the public debt that's accruing with pensions and all that. I don't even want to get into all that. All right. So this is because, as BOFA shows in its chart of the day, while banks and security brokers have greatly reduced reliance on overnight funding as a result of Dodd-Frank, the rest of the market has approximately doubled its reliance on overnight funding since the 2008 crisis. So look at this chart. Check it out. Here's the peak in 2008, right before the mortgage-backed security crisis, which was supposed to be the big reset for Western empires and even Japan and China. But the central banks came and saved the day, so they expanded it, right? And here we go. Look at this. Reliance on overnight funding within non-banks has doubled since 2008. Look at this. This is a credit bubble. That's why overnight lending is becoming so large. That's why they can't do this forever. And I know everyone is starting to think, everyone's capitulating. They're starting to think that markets will just keep going higher. Central banks will just keep propping everything up and liquefying and printing and not QEing. And everything's going to be okay forever. It's not. They can't. It, like I said, it compounds upon itself. That's what credit does. Oh, that's what JP Morgan said. Gold is money and everything else is credit. With interest. All right. And while one can argue that the proper metric is repo funding as percentage of treasuries and mortgage-backed securities outstanding, the bigger picture is that if repo markets stop functioning today, the amount of treasury and mortgage-backed securities held outside of banks, dealers requiring liquidation for lack of funding would be about twice as large as 2008. And as BOFA warns, with today's surprisingly low levels of liquidity in the liquid markets, the impact could be massive. In this context, BOFA views the Fed's purchase program as integral to the promotion of easy financial conditions and supportive of asset prices, which, as Chair Powell himself admitted, is the second key criterion for QE. At this point, it is worth considering a critical if the question, why is the Fed so concerned about not signaling QE? And why are so many Fed fanboys desperate to parrot whatever Powell is saying day after day? Meaning, everyone's saying this is not QE, not QE. Why are they so scared of people saying that it is? Right? Because it's a red flag. There's some serious problems here. Simply said, it basically means that all the QE and the artificially low interest rates from 2008 didn't work. All it did was make things worse. That's the problem. Simply said, there are several reasons why the Fed is making a great effort to let the world know that its security purchases are not QE and are not reflective of any change in monetary policy stance. The first is the obvious issue of signaling concern around the economic outlook, which would run counter to its cautiously optimistic and often upbeat assessment. Yeah, they're constantly cautiously optimistic. What the hell? Anyways, after all, why do QE if the economy has never been stronger? And the Fed was hiking rates as recently as December. Included here are the concerns about running out of ammunition at the zero lower bound of rate policy. With negative rates increasingly off the table, until push comes to shove, of course the Fed is forced to cut below zero. QE is meant to be reserved as dry powder for any rainy day when conventional tools are exhausted, even if QE is in fact taking place this very instant. And that is insane, guys. Think about it. QE, when it was first implemented during the time when the market was imploding, was the last minute thing to do because money market mutual funds, there was a run on the money market mutual funds. There was run on the banks, guys, in 2008. And then they did QE, which was also insane. And everyone was like, oh my God, they're socializing the stock market and the entire economy. And this is and that's why gold and silver took off for 10 years after that. It was because they printed $4 trillion to do it, right? Now think about this. Market's all-time high. Everyone is complacent. They think everything's okay. And the Fed's doing QE. And we're literally below 2% on the interest rates. coming up on zero again. So is the Fed going to have any ammunition to stop the next turndown? I mean, the only thing they'll be able to do is print like, I don't know, 10 trillion or something. And when they do that, and when the market prices that in, the dollar is going to be cut in half in like one weekend or something. I don't know. So the public might actually, they're going to try not to do that, because if they do that, then the public will freak out. And what happens when people think that their dollar is going to keep losing value? Then you get the crack up boom. And the crack up boom is, oh my God, I need to go out and buy everything I need now before my dollar is worth less next week or next month. So it's going to get crazy. All right. Last January, the Fed made a momentous decision to run an abundant reserve regime, also known as a floor system, where the central bank decided not to return to its pre-crisis days of zero excess reserves. As such, the central bank now views the proper level of excess reserves a Fed balance sheet liability, not in terms of its dual mandate for inflation and employment, but in terms of how banks prefer to meet the regulatory liquidity requirements and how this preference impacts repo and other markets. So, they do this every year where they make this test for the banks to see if they're properly funded and liquefied and all this crap. Although the test does not... The test is made for depression. It's not made. It's based off of a recession or depression. It's not based off of a inflationary depression. Because if they did do that, the banks would fail, and that's what I think might be coming, which will probably be coming. Here, Buffett adds ominously that by deciding to dynamically assess bank demand for reserves and reduce the risk of pockets in repo markets, we believe the Fed has entered uncharted territory of monetary policy that may stretch beyond its dual mandate. And the punchline, by running balance sheet policy to ensure overnight funding markets remain flush, the Fed is arguably circumventing the most important brake on excess leverage, the price. So they're allowing the banks to get excess leverage and essentially be irresponsible, like Lehman Brothers back in 2008. According to Buffett's Axel, the most worrying part of the Fed's current asset purchases program is the realization that the ongoing bank of footprint in repo markets is required to maintain control of policy rates in the new floor system. Or as we put it less politely, banks are now able to hijack the financial system by indicating that they have an overnight funding problem, as JP Morgan very, very clearly did, and forced the Fed to do their really JP Morgan's bidding. Again, this is like the Fed just bailing out the banks. Nothing new. And it's technically the public, because whenever the Fed makes money, right, we have to pay it back with interest. Or we pay it back with inflation. So our dollars just go not as far, and that is stealth. It's like a stealth tax. All right, and this is where Bofa's warning hits a crescendo, because while repo is fully collateralized and therefore contains negligible counterparty credit risk, there may be a situation in which banks won't want to deleverage quickly. For example, during a money run on liquidation in some market caused by a sudden reassessment of value, as in 2008. All right, going back to repo and such a crashy part on suddenly value reassessment mentality environment, it seems implausible to expect banks to maintain their level of repo lending. And if repo lines were drawn down far enough and for long enough in time, it could lead to deleveraging at institutions that were otherwise healthy, precisely what happened during the financial crisis, when the lock-up of Lehman's various overnight funding lines instantly cascaded across the financial system, resulting in an overnight paralysis of the U.S. shadow banking system and resulting in the near bankruptcy of the largest U.S. bank. See what I mean? Therefore, to Bank of America, this new monetary policy regime actually increases systemic financial risk by making repo markets more vulnerable to bank cycles. This, as the bank ominously warns, increases the interconnectedness, which is something regulators widely recognize as making asset bubbles and entity failures more dangerous. So what this does is it intertwines the banks even more. And our derivatives markets, which, nobody talks about. Think of this as Europe's infamous doom loop, only in the US and instead sovereign debt. It uses repo as a risk intermediary to keep the system functioning. So they have no choice. It's either you keep the music going and you make the problems even more worse, across the entire globe and through the rot. Like I said, guys, it's like a cancer. It just rots through the entire system. Or you don't help them and then the system falls apart. Either way, nobody wants it to happen on their watch, so they'll just keep the music playing as long as humanly possible. All right. In short, not only is the Fed pursuing QE without calling it QE, but by doing so, it is implicitly raising the odds, more so than if it simply did another QE and rebuilt reserves to absorb $4.5 trillion or more by purchasing coupon bonds of another market crash. So what they're saying here is actually worse than QE, because they're helping the banks just continue to do stupid shit. Some have argued, including former New York Fed President William Dudley, that the last financial crisis was in part fueled by the Fed's reluctance to tighten financial conditions as housing markets showed early signs of froth. It seems that the Fed's abundant reserve regime may carry a new set of risky by supporting increased interconnectedness and overly easy policy, expanding balance sheet during an economic expansion to maintain funding conditions that may short-circuit the market's ability to accurately price the supply and demand for leverage as asset prices rise. In retrospect, we understand why the Fed is terrified of calling the latest QE by its true name. One mistake, and not only will it be the last QE the Fed will ever do, but it could also finally finish what the 2008 financial crisis failed to achieve. Only this time the Fed will be powerless to do anything but sit and watch. So this last little sentence here is what scares me even the most. 2008 financial crisis was the free market tries to get all the malinvestment and the over-leveraged malinvestment, and that's what Great Depressions and recessions, that's what they are, guys. It's the free market. It's the organic economic system. It's like a forest. It's like an ecosystem trying to wash out all of the malinvestment that is poisoning the entire economy and the global economy at this point. And that's what 2008 was. It was just the economy and the markets trying to get rid of the rot, the overrot, trying to wash itself of the cancer. And next time that it tries to do that, which is probably trying to do that right now, and when it does that, that's when interest rates just rise and rise on their own, and the Fed can't do anything about it. And the scary thing is, next time around, the Fed might not be able to do anything about it. And what does that mean? I don't know. We've never seen anything this bad, this big, and this bad when it comes to debt, leverage, and then the economy itself has been deteriorating. Okay, so let's get to the news. The news today. So I posted this chart in the newsroom a few days ago on the 12th. Price was at 1450, and I've been saying for the past week or so, buy the dip, right? And the price right now on gold is at where is it? Well, it just dropped, but it did run up to 1476. Right now it's at 1466. I'm not that worried though. All right. What's this? I'm not going to play that. So this is the newsroom. So, you know, all around the world, guys, there's just riots. And most of it's because of financial. But it's not in the news, right? Alan Greenspan says there's no point for central banks to issue digital currency. I mean, he's right. Guys, they already have digital currencies. Most of the supply, like 99% of it's just ones and zeros. And they just move, they change balance sheets, right? And hold on, let me get my dog. Let's make him beep. Got his collar on. Stop it. I have an Australian cattle dog. He's a very good dog. He doesn't bark normally, but you know, he hears the FedEx or the mailman and loses it. What else is going on? I'm still expecting a pullback on the S&P 500. I'll go over the charts in a second. Trump tweeting, it's just hilarious. He's hilarious. The billionaires, guys, listen. I hate them as much as everyone else. The problem is those guys, the income tax that was meant for the billionaires and the millionaires, like, you know, 60 or 80 years ago, whenever they started it. Who pays it now? The middle class. And they don't pay it. They always have loopholes, or they'll just leave the country. They have shell corps on small islands out in the middle of the oceans. Guys, they don't pay them. They never do. That's why they make philanthropy. That's where they hide all their money. Those will end up on you. And it destroys the economy. And it destroys the small business owner. Envy is one of Satan's tools. Although, this ass. Anyways, he left Goldman Sachs not too long ago. He knew when to get out. You know, the rats do leave the shit. And as of late, October this year was the largest exodus of CEOs, like retiring and leaving. And then when they retire and leave, they sell their stock shares after they, you know, did all the stock buybacks. They take on loans, or they take their revenues and their earnings, right? And then they buy their own stock. Their stock price goes higher and higher, hence stock market bubble. And then they sell their stocks as they exit the company, and they hand off the bag to the next sucker. I know too much. Some things I'm not going to talk about. If you want to read them, they're in the newsroom. So, yeah, I posted this today or yesterday. So, the unemployment rate, aged 15 to 64. So, you know, when people start working for the U.S. The gray areas are recessions. All right? This is the longest running expansion in U.S. history, probably for the world. And this is where the unemployment rate is currently. It's starting to tick up. And it bottomed. I'm very, very certain it bottomed already back in 2015. Then the Fed started hiking rates, and now it's starting to tick up, the unemployment rate. So it's very low still. It's very low still. That's why, you know, Trump could still brag. But once it gets past this black line right here, this zero, and it's no longer negative, that is going to signal right before the next recession. Or whatever it's going to be. It's not going to be a recession. It's going to be like, I don't know what they're going to call it. The global financial reset. The I don't know. Who knows? They won't call it, something that'll scare people. Yeah, you guys can read some of this stuff. Again, guys, U.S. futures rise. Today we hit all-time highs. We're like 30 points off on the Dow from hitting 28,000. Because of a new trade talk deal, whatever. They keep recycling this crap nonstop. All right, let's look at these economic numbers. So the most important ones. So U.S. retail sales year over year. This is year over year. Look, it's dropping pretty decently right now. Right before the holiday season. It actually should be... well, this data is from the last few months. So we'll see how much it ticks up after the holiday season. But it is dropping, and that's concerning. United States exports just tanking. So U.S. is not exporting anything. And this is year over year. Year over year, guys. That's bad. Really bad economic data. Imports. Even imports are just falling off a cliff. Year over year. This is year over year chart. Since June of 2018. So we're not exporting or importing. That means the economy it's not moving. It's not turning. Here's some more economic data came out today. Industrial production. It missed, the forecast, there wasn't a forecast, but it's negative 1.13. Previous was only 0.07. Industrial production, negative. Forecast was 0.4 negative. It's 0.8. Manufacturing production, month over month. Again, negative. I mean, they're all missing earnings. United States manufacturing production. Look at this chart. It's slowing down. It's slanting down here. Trend is down. United States industrial production. Look at this. Just falling off a cliff since August of 2018. Schiff said, as Trump boasts about greatest economy ever, the Atlanta Fed just slashed its estimate for Q4 fourth quarter GDP growth to just 0.3%. 0.3. That's really low. I don't know when last time it was that low. Maybe like 2009 or something. GDP will ultimately rise less during Trump's first term than it did during Obama's second term. Whereas Trump will have run larger deficits to create less phony growth. So deficits are exploding, the highest ever, and the GDP is actually going to be worse than Obama. Like, I don't know how Trump's going to run on the platform that he... That's what I'm saying, guys. The market hasn't even priced in a possible... I'm saying possibility. The possibility of him not getting reelected is enough to really tank the markets. And then if the markets do tank, then it becomes a self-fulfilling death spiral. That's the problem. Here's the chart of stock futures slip as trade tensions weigh. No progress is made. Administration's tough. I've shown you guys. This is hilarious. I am hilarious. International. All right. So let's do a little bit of TA. This video's getting long. No one's going to watch it. Look at this. S&P is just shooting higher. We're at 3,115 on the S&P 500. I do have a 9 sell according to the TDI indicator. This is a daily chart of the S&P. The heat map is telling me we're due for a correction. All oscillators, RSI, momentum, everything, MACD, everything overextended, like hardcore overextended. This should be a nice blow off top. We'll get a shooting star, in my opinion. That's what I think will happen. And then we're going to get a nice correction to this entire rally. This rally's been pretty significant. It's been running for... Guys, I mean, it's going to lose momentum eventually. It can't just keep going higher on BS trade talks. It's been going higher since August. It had a small dip during September 19th. So I think soon, next week, week after, it has to come. It can't just keep rallying like this. Let's take a look at the smaller time frames. Here's a 12-hour. It's on a 6 count. So 7, 8, 9, maybe, maybe another day, maybe Monday and Tuesday, market may go a little higher, and then I'm expecting that correction. Look at the RSI, guys. This isn't overextended. I don't know what the hell is. All right? It's just that simple. MACD is going to cross to the downside. It's going to happen soon. And when it does, metals are going to rally and continue to rally. Metals have already popped in anticipation. Here's the 6-hour chart. We passed the 9 sell. But let's see how the market closes. It's only 2:45 p.m. U.S. Eastern Standard Time. We still have another, few hours of market. So if this sells off prior to the close, then this might be it. Let's take a look at the 4-hourly. 4-hourly is on the 3 count. Hopefully the 3 count breaks down before the market closes today. Today Friday? Today's Friday, I think. So, yeah, today should be Friday. And, yeah, we'll see what happens over the weekend as well. Here's gold and silver mining ETFs. They had a nice pop. These are daily charts. They had a nice little pop. Listen, this is all consolidation on everything. All right, here's the markets. The VIX, volatility index. It's hit pretty rock bottom low. You could trade the VIX. A lot of people say you don't do it. I've done it, but it's a very short-term trade, like a day trade, maybe a day or two. All right. But they slammed the VIX real hard. But look, it's at all-time low. So this is going to signal also a sell-off. I mean, it's due for a sell-off. It's pretty obvious. I don't know who's buying. Day traders, I don't know. Fed's buying. I wouldn't be surprised at this point. The dollar, it's starting, it had a nice little rally in the past week, which is weird, but if it could just retest again the 97 handle, that'd be great. I expect that to happen in the next few weeks. So if the market sells off and corrects, the dollar falls to the 97 handle, perfect storm for gold and silver, guys. For another rally. Rates, the 10-year yield. It started dropping this week. It's the blue line. Let me make it a little thicker here. Well, you know what? Let me just... You guys can see that, right? Yeah, you can see that. So I'm looking for the 10-year yield to drop again. As soon as it does that, gold should continue its rebound. Right now, it's not a rebound yet. Right now, it's just a bounce. I'll go to the gold chart in a second. So here's gold, and then I'll look at silver. Silver is, I'm surprised it's not at like over 20 bucks. I'm surprised it's not at 30. Should be at 50 bucks, considering where gold is price-wise. That's the market they really hold down. All right. And they do it so the manufacturing companies and all these tech companies could afford to make their technology, because that also boosts the economy. The long-term consequences of this is the physical supply is going to dry up, like on the crust of the earth that is easily mined and readable, because mining is extremely cost-inducive. All right. Huge bull flag on gold. I extended the bull flag. I thought it would have broken out. It tried to break out right here, but listen, guys, it's manipulated. And that's why I'm going to talk about how to trade this stuff even while it's manipulated. But eventually they're going to stop and they're not going to be able to do it. So I think once gold hits new all-time highs, I mean, they'll do it, but it won't be that effective. Anyways, it's above the 38.2 fib retracement. Moving averages are going to cross over here, and that's negative for the price. But if the price could go above the 100-day and the 52-day moving averages on the daily chart here, then we're looking good. Gold just needs to rally above 1,500, and there you go. I mean, I'm expecting we're going to be testing 1,600, 1,680 is where we hit the next major resistance area. So can it trade sideways around 1,480, 1,500? Yes, it can for the next few weeks. It can. It's fine. But, you know, it all depends on how bad the pullback will be on the equities and how much lower the yield, the interest rate yield could go on the 10-year, and how much the dollar sells off. But all three doing it at once will be very bullish, and I expect gold to rally above 1,500. They'll signal another leg up in this bull market in metals. And when that happens, guys, these mining stocks that have literally taken 30% pullbacks since the high here are going to explode in price really quickly. Really quickly. And we don't know. I don't know if we'll ever see the prices. So the today prices in gold and silver mining stocks, I do not know if we will ever see them this low ever again. Or for the next, 5, 10 years or whatever. So that's why, as I make money, I'm just buying and loading up on mining stocks for the long term. And you should do that as well if you haven't. And I'm buying all the dips. All the smart money's buying all the dips. Go to my website. It's 15% off. And it's good. It's really cheap. And listen, more research is coming out this weekend on prospect generators. More those lottery stocks where you throw $50 in, maybe it'll be worth a lot in the future. We'll start talking about those more for the private members. Let's take a look at silver. Silver hit support, the 52-day. So once it can get back above 1740, it's looking very strong. Then it's going to find support at 1740. And then just like gold needs to get above 1,500, silver needs to pop back above $18. Once it pops back above $18 and closes above it for at least a day or two, then we're back on, risk on, right? And another leg up in this bull market. Can it trade sideways and bounce around for some time between 1740 and $18? Yeah, sure. But that means that it's strong. The market's really strong for metals going into to close out the year and going into 2020. All right. I'm hoping gold will just go above $15 and then it'll just drag silver with it. Open interest right now in gold and silver is really, really, really high. It's like 1,700 million or something. For gold. If there's a huge short squeeze, oh hell yeah. I mean, gold and silver we're gonna see a huge move on them, definitely, to close out this year, and that'll be awesome. Because I'm personally still long on my ETF. I've actually added to that position like all week this week, and last week, and the week before. Of course, I didn't see that huge dump coming, because, that's what they do Sunday nights before the market opens Monday mornings. And my next video, I'm gonna teach you guys how to trade this stuff. All right. So smash them likes, leave anything in the comment section. Please share my videos. It's literally the only way my channel grows, and it's literally the only way I'm gonna keep doing this until I'll be on other platforms. You guys will be able to find me, and please go to my other YouTube channel, subscribe there as well. It really helps me out, and go into the private chat groups. Links are below, and take advantage of the 15% off. Invest in yourself so you could buy more gifts for next holiday season. All right? It's a gift that keeps on giving. Until next time.